This podcast is proudly brought to you by Term Plus. What I like about Term Plus is its easy to use online platform, giving you access to high-yield term-based accounts, providing consistent monthly income. Owned and operated by Pengana, an ASX-listed company with 23 years of experience, Term Plus is democratizing access to global private credit markets. Visit termplus.com.au to learn more and read the PDS before investing. So you're going to see Lime Cordial.
Yep.
Nice, man. That's great.
With lime cordial, maybe? I'm not sure. What do you think?
Maybe. Welcome to this episode of the Australian Investors Podcast. That's what I think.
Yep.
We're not talking about the latest Gen Z singers and pop stars here on the Investors Podcast. We talk about real hard-hitting facts. Like, is Endeavour really a dog? That is the stock. Is it good to own ETFs?
I said last week I was going to get into stock picking again. I looked at Endeavour. I'm out. I give up.
Drew is back on the stock picking bandwagon.
Retiring.
We're going to analyse Endeavour Group, which is the basket case that's spun out of Woolworths.
Not like preempting what our recommendations.
Oh yeah, sorry, no,
general advice only.
Open,
completely objective reviews.
Yeah. Anyway, we'll cover that. We've got a few questions sent through. There's a lot of news out this week. There's a fair bit of stuff going on around the world. Jamie Nemesis just came back from his junket in the USA. Mitchell Snedden from Rask also just came back from his junket. Turns out they were on the junket together. So
with a bit of a tan, probably, both of them. Yeah, nice and brown.
Yeah. Mitch went to Harvard, so we've updated his bio on the Rask website.
Visited Harvard once.
That's it. Yeah, he's been to Harvard.
Yeah.
So
they kicked him out, but it's fine.
He had a beer on the lawn. Yeah. So, all right. But what's making news this week? What's been happening with you?
I've been keeping an eye on the future fund. Like, this is my little bugbear. I think we all went through this period where it was like, oh, let's invest like the future fund. There's a lot of companies that say, you know, comparing, here, invest like the future fund, get alternatives, get private equity. The future fund does it so well. And this, I mean, I used to love it, but every year it seems like someone from the future fund comes out and says how hard it's going to be to make returns this year. The world's changing. We're in a new paradigm. Return expectations need to be lower.
Yeah. And
lo and behold, 12.2% for the financial year. I mean, it's 3 months on from the end of financial year when they're reporting it, but 12.2%. So outperformed pretty much every major industry super fund, underperformed VDHG and Rask Invest, I believe, for the financial year, 12.2.
Oh, yeah.
For the financial year. Yeah.
Well, what's the asset allocation?
So you outperformed the future fund.
Yeah. What's the asset allocation on that puppy?
Oh, it's like 1090.
Oh, yeah.
It doesn't hold cash and fixed income.
Yeah, we smashed it.
It holds credit, hedge funds, private equity.
You can see the mix here.
I put that, snuck that.
$250 billion under management. This is like the government-backed super fund.
It's supposed to be for the defined benefit liabilities of
the government
politicians, basically. It started with like 60 billion, and now it's up to 240, which shows you the impact of compounding.
It's basically a half-baked attempt at a sovereign wealth fund.
Yeah,
which we should have, because we should take the royalties from the mining companies, which rip up all the earth, and then give away something to a foreign country. We should take a very small percentage of that and put it into a government-backed thing.
And there's talk like that it should be made available for people to invest their superannuation into. Like all these things come up all the time because it's so amazing. And yes, it's been great. But I like this. There's a chart that was in the Fin Review this week that showed the kind of asset allocation, and it's debt, hedge funds, and cash were all in the same group. And that looks like, I mean, it probably represents about 30%.
That's why they don't open it up to outsiders, because if they did that type of disclosure, it probably wouldn't.
Illiquidity. But I find it interesting that they're massive proponents of private markets, private equity, hedge funds. And then the biggest driver apparently of returns was a decision to significantly increase their listed equity exposure by 5% this year. So they had the same tailwind as everyone else, a large exposure to global equities.
Well, that's what I was going to say. Since 2009, is that when it started? I don't know when it started.
Thereabouts,
yeah. It has maintained, what's that? I'm trying to attempt at what the percentage would be, but it looks like it would be less, 10% or less.
Yeah,
is in Australian shares.
Yeah.
When you think about everyone listening to this, if you've got, most of us would have more than 10% of our money in Australian shares, like our supers and our own individual accounts. The future fund only has 10%. It did start with Telstra, remember? It's got like 30 or 40%.
It's the future fund that's selling out Telstra.
Yeah. It's got like 30 or 40% in global shares. It's got like another 20-ish% in private equity, property and infrastructure. and then it's got like another 30% in debt, hedge funds, and cash. Which you're right.
Yeah. This could be a chart
that could be
too.
the AFR chart crime. To be honest, probably not the future fund. So
no, I thought that was super. And the global equities are the things that have driven the return the most.
if I had a portfolio worth $250 billion, I would probably think that I could like swim to Mars if I could get a 12% return on that.
Yeah.
Because you would think you're a champion. Like imagine having that many zeros and you're like,
woo,
well, I could buy all of CBA.
Yeah, if I wanted to, yep.
Like what would you do with that amount of money?
You could just buy CBA and privatise CBA.
You could. What would you do differently?
With this?
If you had 200 and say
I'd probably
50.
have more listed markets. Like managing private markets to this level would be a lot of work. They're doing private market investments directly. Like surely, I mean, they're a government entity, so there's no profit and loss they have to worry about. But you and I, I'm not sure. We'd be trying to cut costs or just outsource everything now. You're at 240 billion.
Just get a Filipino team to manage the portfolio.
Would the S&P 500 reinvested have outperformed this? It's always the comparison.
Yeah, ChatGPT to do my investing research.
Maybe a bit more domestic looking. Maybe we're Australian. Maybe Australian companies need some money.
Yeah, but
they've done everything right.
They could probably buy the MCG for this, I reckon.
I'm more like why you talk down how negative, how bad it's going to be every year. And you don't even have shareholders that you have to talk down. Fair enough, like a fund manager saying, oh, it's going to be a difficult year to set expectations lower, but they keep doing it. They keep generating. They're over 8% on average since inception.
I've just asked ChatGPT how much the MCG is worth. Let's see what it comes back with. I said best guess.
20 mil? 200 mil?
Oh.
50 mil?
As of... you said what? How much?
I don't know. I said 20, I said 200, I said 50.
What are you going to go with?
100?
As of 31 March 2024, the value of building improvements and capital works in progress, I don't know where they're getting this from, for the MCG, as carried in the accounts, is $298 million.
Oh, nice.
That's $1 million of the capital works. It would have to be more than that.
I mean, what about the rights to sell beer there? I'm sure they're more.
Well, they own the MCC as well.
Yeah.
No,
the MCG trust.
ChatGPT
is making something up here.
If it was 300 million, some property developer would buy it and just put up 27
apartments, 400 townhouses.
That's it. Yeah, jeez. Anyway,
I think it has some sort of heritage.
Well, my point is, if you've got like $250 billion,
what are you going to do?
What are you going to do? They end up buying things like
by the toll road,
Sydney Airport, or major highways. And stuff.
They don't do what Australian, some of the big industry super funds have bought entire companies.
Yeah,
they don't seem to be doing that. They technically apparently had an external, they had to use external fund managers, but apparently that wasn't 100% clear that they had to use external. You have to buy bigger and bigger assets, and you have to go global. Like ART and Australian Super, they have to open offices overseas now, and IFM. Because they'll move the market too much. If they had more than 10% of their portfolio in Australia, if they had too much, 50% here or 35%, it would be starting to move stocks when they make a decision. And they're active as opposed to the industry funds, which have had to be more passive. So active decisions are going to swing the market more. So you're buying bigger assets, you're buying shopping centers overseas, you're buying buildings, you're buying blocks in New York, all that sort of stuff.
Okay. You have to tell me, what are the three biggest super funds in Australia?
Australian Super.
Yep.
ART.
Yep.
And Host Plus. Aware Super.
Yeah, it is. I didn't know Aware that was that big. Yeah. That's like the health professionals one.
They've just all merged.
360 billion. This is according to Super Guide. Absolutely fantastic resource for retirees.
I went on to APRA this week too. And downloaded the stats on industry super funds. So it was quite interesting.
360 billion for Aussie Super. 310 billion for Australian Retirement Trust, which is the one that we recommend as default at Rask. Aware Super is 183 billion. Then it's UniSuper, Public Super Health
Host
Fund,
Plus is in
Host
there.
Plus, Cbus, Colonial at 97. That's pretty big. Hester, Rest. Hester's going to go to zero, let's be honest. MLC, Mercer, IUF, AMP, Care Super's like 15th.
I was looking at the stats. I was doing a little bit of a white paper blog post this week. And I was looking at APRA. You can download how many members they have and the assets held in each type of category. So Australian Super average balance over or under 50 grand.
Over.
100 grand average balance in Australian Super. Host Plus over or under 100 grand.
Under.
60 grand is the average at Host Plus.
There's a lot of young barefooters.
Yeah. Hub 24 over or under 100 grand average.
Well over.
Yeah.
I'd say because most financial advisors, I reckon that would be
Yeah.
like if I was to guess the average, I'd say 350.
Very close, 339,000.
Really?
This is a very basic average taken from the APRA data.
Yeah.
And what I found even more interesting, and this is maybe it's more relevant for the Australian retirement podcast, was that having a look at the options, only 3% of people, or 3.5%, are in retirement phase or an income phase within Australian Super.
Only 3.5% are in retirement.
This is just looking at the pension income accounts on Australian Super. ART was 4.5%. And then Hub24, 35% of people in Hub24 are in the pension income accounts.
That's because everyone knows that once your balance gets over like 300 grand, the industry funds are not cheap anymore.
Yeah, exactly.
And you're just better off going to Net Wealth or Hub or something.
And at retirement, people
Macquarie.
want advice. They want to ask questions. They need, and a lot of the time they can't get anything other than general at an industry fund.
But that's the thing, like, and we can talk about this, but like,
Good for accumulators.
Good for accumulators because you can choose like index options and stuff like that. But like, honestly, you can, the industry is changing in a big way. Obviously, the Labor government wants to help the industry super funds keep winning, but more and more consumers are being financially educated and they realize that they can actually control their super, prudently. They can just go in there and be like, here, choose this index fund, or here, choose this, like really simple, like Perla, which is a sponsor of our finance podcast, offers super.
Yeah.
Right. Beta shares. Now they bought the Bendigo Bank super license, Hubs super, NetWealth super, North super, Macquarie does super. Who else does super? Like they all
everyone.
Rays does super. Yeah. So they all kind of do super. So yeah, it's if you want to get more control of it, don't change super funds until you've read the PDS and review your insurance always. But just interesting.
Did you have your shares in Oracle?
No, but I did give Larry Ellison a call, and he said to me, "I'll just give you some of the." I think he his personal net worth went up $89 billion. He
became the richest man on earth for like 8 minutes, and then Elon popped up.
80 wasn't it? Didn't he add $80 billion to his net worth?
Yeah, 323 billion
in like 3 hours.
Yeah, that was crazy. And I also saw his son David. Have you seen this overnight?
Yeah.
CEO, is it Skydance or? He's trying to merge. Is it Paramount, Skydance? Everything's merged, and Warner Brothers. There's a merger
Is
proposal.
that his son?
David Ellison, apparently.
Oh yeah. It looks like
and
it. Yeah, it makes sense.
Funded by Larry's newfound $80 billion.
Now,
because one movement in the market in Oracle in one day can buy more than two, probably 100 of the other S&P 500 companies.
Now, we could have a segment on the show called Lookalikes, but I'm just holding up my computer screen here.
Don't tell me this is not me.
This is a lookalike almost of like Brandon from New Money.
Oh yeah, for sure. He'll love that.
Brandon, if you're
listening.
Shout out to
Brandon.
Brandon, Australia's biggest YouTuber for investing content. Brandon, if you're listening, David Ellison, buy hold sell.
He needs to cut his hair.
Yeah.
Brandon's to look more like David.
Brandon.
I thought that was massive. That was it went up 28% during the market. I like during opening hours, and then went up 36% in total after it closed.
Funny story. Some of our clients work for Oracle and they get stock.
Oh no.
They get stock. No, like good. This is a good news story. Some of them get like 100 grand stock US dollars
every year.
Yeah.
Yeah.
Imagine that. Imagine being like, I just worked for Oracle for 5 years.
Bang.
30% more in one day.
All right. There's a lot of interest in this at the moment too, because the numbers that drove it are crazy. And I had a buy sell hold on this as well. So they're predicting cloud infrastructure, which is like, and there's a story here about the circular flow of money within AI.
Yeah.
But they're predicting their cloud infrastructure revenue to go from 18 billion this year to 144 billion in 2029, which is only 4 years away.
Oracle's kind of like this. You think of Oracle and I think of like the copyright logo on the bottom of the ASIC website, which is the government website. It's 1996.
Yeah.
Like,
I don't even know what they did. I wrote an article about Broadcom today. I didn't even know who they were.
Mate, Broadcom, unbelievable business. The two gigantic tech stocks that no one talks about, Oracle and Broadcom.
Because the code's AVGO and no one knows what AVGO is.
Yeah, they need BROD.
Yeah.
Bro.
That would work.
That would. Yeah. They have, I think they've got something like, isn't it like $500 billion of remaining performance obligations.
300 billion in computing power bought by OpenAI
In one go.
in the next to be delivered over the next 5 years. So they have to deliver on all that. They have to obviously raise capital to do that probably. This was the interesting thing, the quote, the flow of money, and I think this is from Bloomberg, the flow of money is even more circular. So Oracle buys chips from NVIDIA to build cloud infrastructure and then rents that cloud infrastructure back to NVIDIA and other groups like OpenAI so they can keep developing products to sell to the hyperscalers. And those hyperscalers also need to rent more computing capacity from Oracle to run the next generation of products from NVIDIA and OpenAI, which forces Oracle to buy more chips from NVIDIA to build more cloud infrastructure.
So basically, Oracle is the company that they all call in.
They all link back together.
To do all of like the actual grunt work.
Yeah.
But like the hyperscalers own the data centers, the chips from NVIDIA, and the cloud computing. Hyperscalers, by the way, everyone, hyperscaler is just like a data center that's owned by Google, GCP, Azure from Microsoft, or Amazon AWS. That's what a hyperscaler is. And it's just about having the latest in GPUs and CPUs located close to major cities, basically.
And they can dump on more capacity all the time.
But basically, Oracle is the company that they would call in to put it all in and to do it.
Yeah.
But this is the crazy thing. So I've got it here in the ticker terminal, tikr.com/Rask, if you want to learn about the ticker terminal, which is what I use for literally all of my research. I don't think I've logged into anything else for years, actually, now that I think about it. I do have a CommSec account from way back in the day. But
I've been looking at it now that I'm back into stock picking.
Really? Yeah, well, even just like transcripts, and you can look at professional portfolios. But anyway, talking our book, we obviously have a partnership with Ticker. They have here, at the end of Q1, remaining performance obligations, or RPO, now at $455 billion. This is up 359% from last year.
So that's contracted revenue that they have to deliver on. And they're plugging, are they building everything?
That's
they're
guaranteed
plugging everything in
revenue before they do price increases and renewals.
Yeah.
Can you imagine that?
It's just a different world.
I'm over here thinking about our Rask Advice business, thinking we've got 4 months of clients outstanding. Yeah. I'm like, $359 billion. 455.
You need a team of 4,000 just to deal with the incoming.
Holy mackerel, you guys.
I went a bit deeper into Broadcom.
You go buy wholesale.
On Oracle, I'm a buy.
If you're doing stock picking now, all of a sudden,
if I say buy, I have to buy it somewhere.
What we should do is next year for our game, in 2026, we are only allowed to pick stocks.
All right.
So start researching now.
Let's wait for a crash before.
Listen,
31 December.
I have no context on valuation but I think the whole cloud computing AI data stack.
Yeah.
You got FANG. I reckon you could I think FANG is a wonderful ETF.
I thought Oracle was something really boring. Like I thought it was like Intel. Maybe that's harsh.
Broadcom, as you now know, makes custom silicon.
Yeah.
So they can customize
anything
for more advanced chips and all that sort of stuff. Yeah. So super, super impressive business. It's just
and they bought the software too, didn't they?
They bought VMware and Symantec security business 2019. They bought CA Technologies in 2018. Yeah, there's more acquisitions further back in their history, but they're unbelievable. Really impressive business that we don't really talk about on the show. Businesses like Palantir as well, just really, many, many moons ago, they spun out of HP.
Yeah, I thought that was super interesting.
Yeah, they were the
semiconductor business of HP.
Yeah. But yeah. So speaking of other things that got let go by the mothership, Endeavour Group. We said last week on the show that Endeavour Group, we would do a bit of a research because we were a bit like, why is this thing so cheap? What did you find this week? You've been looking at it.
I mean, we held Woolies when Endeavour Group was spun out, and the first thing we did was sell it. I mean, in hindsight, we probably sold it too soon because I think it did hold value. It did all right for a little while from memory. Yeah, it kind of held its ground, went up a little bit, and ever since 2020, late 2022, just been a massive downtrend.
Okay.
No head and shoulders there. But don't love it. So we were reminded on YouTube comments that it has a massive chain, like BWS, Dan Murphy's, something like, I think it's 300 pubs. It also has Pokies, and it also owns some of the property as well.
Yeah.
You will listen to some earnings calls, but it's very difficult. This business is very difficult, and I think the vast majority of the revenue still comes from retail,
which
as
is
opposed to the
liquor
pubs.
and that sort of stuff.
Yeah, bottle, and that is
bottle
in
shops.
whether it's structural decline or cyclical decline, we don't know. Maybe it is structural. That the spending on alcohol, the consumption, and the price point of alcohol has all come down significantly, and revenues growth just anemic it's shrinking in retail at the moment.
Absolutely.
And showing very few signs of improving. I just think it's a plus. If you go through the latest, I think the annual report or the annual announcement, it was just a bit unclear. Like they were really pushing their rewards and how important the rewards business is.
Yeah.
But
they got like 500,000 monthly users or something.
It's like they almost need a reset, and I think they're trying to reset while everything's moving. And I find it a struggle even at 15. Is it down to 15 times earnings? 14 times earnings? The dividend was 3%.
No, it's down now. It's 14 times, yeah.
I mean, there's people are spending less on alcohol. People are spending lesser quality alcohol. Retail, like numbers are going down. Options for eating out and food are expanding. The traditional pubs, I think the traffic's still fine at their pubs. That's actually been the highlight of their business, but it's going elsewhere, not just the kinds of pubs that they operate in the massive scale. I just really struggle. I don't think I can buy it. As my dip back in, not even on the current valuation. The growth, you just can't see the growth.
Yeah,
and the catalyst.
Yeah, it's fair. What's the ASX average? What's the actual average price earnings ratio of the ASX? Do you know?
I think it's about 19.
Right. So this is below that at 14.
Yeah.
Yeah, I was just listening to some analyst calls this week in anticipation for today's show, and yeah, it's worse than I originally thought. Because last week we joked that they basically got all the debt, but they also got a lot of the debt. They got none of the technology. They still have to. They've got probably a couple of years. They're all optimistic about this on the calls, but they've still got a couple of years to rebuild their own ERP system so they can actually sell stuff, which is great. If you work for Endeavour, you're probably making bank right now.
Just don't take shares.
Take your shares in Oracle, then go and work for Endeavour and charge more money.
Yeah.
But they got the ERP system, they got the debt, they got falling revenue in some parts of their business. They got Pokies, which most people don't want to associate with. So that means
that's why Woolies got rid of them, really.
Yeah, over time, you'd have to say that it gets a lower price earnings ratio simply because it's not deemed as quote unquote ethical.
And it'll be re-rate eventually.
Yeah, and then
one day
it pays a dividend, but about 80% of earnings, which is
that was a concern.
Yeah, I was like, why would you pay dividends?
Because if you cut your dividend now, they're
gonna create your share price even more. And then they got a new CEO coming in, which I'll leave it to I won't say anything on air, but I think it's a hard business. But here is my question: I'm firmly in the camp of Charlie Munger, which is buy wonderful businesses at a okay price rather than buy a okay business at a wonderful price. Like I'm not interested in buying and trading stocks for 1 to 2 years. But if I was, Drew, here would be my inversion of this conundrum for you. So Endeavour Group is at 14 times earnings, right? Let's take Woolworths at 23. No, let's go Westfarmers at 37.
And it looks like they got like $2 billion in property.
Yeah,
so they're about assets. Property, plant, and equipment, $2.2 billion they had.
So here's my thing for you, right? And this is a way to put valuations in context for people. So let's say that Endeavour Group is half the valuation of Westfarmers, which owns Bunnings and Officeworks, and the list goes on, right? Would you take $10,000 in Westfarmers today or $20,000 in Endeavour Group over 5 years?
Ooh, I think I still take 10.
You take 10 in Westfarmers over 20 of Endeavour.
Yeah.
Because that's effectively, ladies and gentlemen, the valuation flip.
Yeah. So do you think you're going to get a better return on equity on the 10 and it'll make it up to 20 over 5 years?
Over 5 to 10 years, you're going to get the benefit of a good business. Over 3 years, it's debatable because it's kind of guesswork.
Yeah.
I would probably, over 5 years and 10 years, definitely take Westfarmers. But over 3 years, I might be inclined to do Endeavour.
Ooh.
Reason being, I reckon it could...
Quick turnaround?
It could at least hold value.
I mean, 80% of the revenue comes from BWS and Downs.
They did make I can't remember her name, forgive me, the CEO who just did the recent call, Rachel, I can't remember, Rebecca. She was really, really good. She was saying that like the two big drivers are celebrations, things like Father's Day and all that sort of stuff, which kind of makes me cringe to buy alcohol. That's a reason to buy alcohol. But anyway.
Low carb beer is what we turn to.
Yeah. But say she was making a really good point that like a lot of that is seasonal and that's coming now. The second thing she was saying is that we're seeing interest rates come down, which obviously increases spending power, but we're also seeing real wages increase in the economy. So meaning that wages after inflation, because there was a few years there where inflation was so high and wages were just not going anywhere.
Yeah.
So people were crippled in their spending power. But now it might open up and it might be a cyclical play over 3 years.
Mate, but it's still alcohol sales and there's so much, like there's a lot of competition there as well.
Yeah.
Yes, they've got Dan's and BWS, but big format, like it seems like smaller local are doing better now than massive format Dan's. The car park's more, I see more cars in the Tesla chargers at Dan's than in the car park going inside. This is what I call fundamental research. I got to go to Dan Murphy's once a week. And
boots on the ground.
You don't have any sponsors? We allowed to talk about drinks on here?
What's the drink responsibly? Is that the
drink responsibly?
Drink responsibly. Gamble responsibly as well while you're there.
What's it called? Stomping Ground.
Stomping Ground?
Yeah.
Is that like a...
Stomping Ground?
Is that a pale ale?
Japanese lager.
Oh, right.
Low carb.
Shout out to all the guys that make Australian beers. It's a bit of a tough industry out there for Aussie battlers trying to make beers.
Unless you're part of one of the big groups. Oh, Brick Lane. Whoops.
Brick Lane. That's what we're talking about. Jeez, edit that bit out. No, I'm kidding. There's a whole theory. There's a whole like sub-structural trend around these types of industries because they've got Jimmy Brings.
Yeah.
And the deliveries.
Which they merged into Milk Run.
The other one. They're kind of bringing them together. Because they've got that, effectively what I think they're trying to do is use like things like the Jan Murphy's, which have the really big store footprints, and make it as like a distribution center, kind of like how Woolies and Coles now are basically 100%.
Yeah, you just get run over by people filling trolleys, employees filling trolleys in the store.
Exactly, which is what they should do because online people prefer to shop online.
Yeah,
my old man had knee surgery recently and he couldn't go down to the Woolies, and he's just like, I'm just going to do this. Yeah. Why would I? Like, I'm just going to do this.
We do click and collect. Like, and you drive around the back, you open your boot, put it in, gone, out of there.
Isn't it so much more convenient?
So much more efficient.
I just can't
kids,
believe.
Then you don't, you spend less, I think, because the kids can't get into the lolly aisle and that sort of thing. But
yeah, true. But interestingly, so this is a whole supermarket deep dive. But interestingly, the supermarkets now have realized, which I've always thought this would be a real unlocker for them, is they've realized the value of their own network.
Yeah.
So they've got this kind of captured community. So they've got the loyalty programs and all that. But interestingly, if you look in like the Coles app or the Woolies app now, you see sponsored content within the
Crumpets.
shopping. Yeah. Like the Tip Top is competing against the home brand and they're paying for that advertising, kind of like Amazon with the advertising revenue.
That was the business they bought a while ago, wasn't it? The analytics business?
Yeah.
That was almost 10 years ago, ahead of their time.
And then and then they did another acquisition not too long ago, which was Quantium.
That's it.
Quantium, which we had Brian Hartzer on the show. He was in the health division, but Quantium uses like massive data business and does AI and all that sort of stuff. Yeah, the analytics is super powerful for these organizations. Yeah. But if you think about that, they're basically going, okay, we're going to become a mini distribution center. We're also going to run ads, which is a really good business model.
Which should improve your margin.
It's kind of like competing for shelf space.
Yeah.
People don't really know this, but the beer companies actually have relationships with the pubs.
Yeah.
So the pubs can influence the price of the beer. And sometimes the beer companies have to subsidize the beer, make it almost free for the pubs just to put their beer in.
The volume, yeah. Yeah. Because they pay. Some pay.
That's why new beer entrants can't compete.
Yeah.
Because they're going up against CUB and Asahi and all these brands.
You get poor contracts and that sort of thing.
Yeah, which are just like, well, you know this. You went to buy a pub, didn't you?
We looked at a couple of pubs, yeah. Maybe that's a later career move for your publican. That'd be fun. Just what are we going to call it? The Derrimouth.
The Derrimouth. Just what's Jeremy Clarkson got? He's got the farmer's dog.
Something like that. Yeah, he's got his own farm. Yeah, the It Depends pub.
Yeah.
But do you have lager on tap? It depends.
People would actually.
But there's pork on. You got to pay to be on, like to be the preferred vodka in all the vodka-based drinks at a cocktail bar. It's a contract.
This is the thing, right? Like people don't know. I feel like 99% of people that drink at a pub don't know this.
Yeah.
So if you're the beer company, you pay to be on tap.
Yeah. Particularly if it's a good pub.
Yeah, you get like the iconic stuff. Which is why, again, it's so hard for Australian business like beer companies to compete because they have to compete against these companies that have unlimited volume and unlimited whatever.
Ability to pay, yeah.
Yeah, they can just... Yeah, anyway. So back to Endeavour. You buy, hold, sell.
Sell. It's my quickest answer ever.
Okay, so buy, yeah. I'm not interested in owning it, and therefore I would say for me personally, it's a sell.
Yeah.
But if I wanted kind of like a value play, if you're into value investing...
Not anymore.
I'm not anymore that much. But if I was, I think this... Of all the companies I've got on my list here in the ticket terminal, Westfarmers, JB Hi-Fi, and Woolies, I would look at Endeavour first.
Yeah.
Because there is value to extract there. I just don't know.
And it's smaller, so it can move. It can be more impactful. Woolies, it has to do a lot of things to have a big impact.
Yeah.
Same as probably JB Hi-Fi too.
I was thinking about this on the way in with the new CEO coming into Endeavour, Pat Dorsey, who wrote some books, and he was the former head of research at Morningstar. He always used to say that if you have to choose between the horse and the jockey, pick the horse. Meaning, and Peter Lynch said a similar thing, that if you're out there and you're investing, you've got to focus on both the management and the strategy, but also like the business itself.
An idiot can run a good business.
That's it, yeah.
Yeah.
And I think this is a hard business, so it will require a really good CEO.
Yeah.
And so if you don't think that that's the strategy horse. And the person,
Dan Murphy's is the horse, yep.
And I think that whole analogy that those guys talk about, I'm interested to hear your thoughts on this. If you have a hard business, the CEO has to be exceptionally good.
Yeah.
Exceptionally good. Kind of like Malone was with whatever, can't remember his telecom network. Kind of like that. John Malone.
Yeah.
Yeah, in the US. Anyway, I'm probably sell as well. So if you want us to look at another company in the next few weeks, like we're happy to have a bit of fun. I need some ideas for 2026. That said, like I don't probably want too many ideas from the Rask community because you guys kind of...
Vulcan might come up again.
I've got a story about Vulcan. Dizzy Rask.
Did they reach out?
No.
Is there a legal letter?
What'd they say?
Send them to Owen at
stop selling
Rask.au.
Stop saying the truth. So the Dizzy Rascal's $10,000 community portfolio is up plus 8.19%. So 8.2% for the year. Big winner is Meredith Group, which makes sense because it's good business, and Soul Pat's also a good business. Big loser is Vulcan. No, I went to a lovely restaurant the other day and got a nice wine, I've got to admit. I don't normally drink at all.
Was it Endeavour?
No.
They own 3 wineries too.
It was from, I think, the Vulcan Valley in Germany.
Oh, okay.
So I was thinking...
Like the Vulcan Valley. Oh, you mean like Moselle or... Was it a Riesling?
No, it was a Pinot.
Oh, Pinot. All right.
I think it's Vulcan Valley, isn't it? In Germany?
Is that a valley?
I thought it was like the Rhine Valley, but it's called Vulcan.
Oh, yeah.
The actual thing's called Vulcan, and it's in the Rhine Valley. This wonderful...
Oh, you're saying a pivot into wine.
I'm saying, forget lithium, wine. Germany can do wine.
Yeah, all right.
Anyway, so back on track.
Geothermal wine.
Geothermal wine. Bubble the yeast on top of the...
Geothermal.
Next up is the Everything portfolio from the Honourable Drew Meredith.
Is this going to be like Kobe? Oh, I mean, rest in peace. But his last season, like you're just going to enjoy the next 4 months of every week. It's going to be RPM Global for the rest of the year.
Yeah, you only need one, you know.
Yeah.
11.86. So you're well ahead of the community portfolio. You're solid, is what I would say. You've got some really good companies in here. Like Nvidia's up 23%, Prometheus up 20%.
Spread, risk-adjusted returns.
And Tesla has started to come back. So
it's only down 15% now.
Yeah. It's actually, I think the biggest thing that's getting you is the currency on your US shares.
That'll turn at the end of the year.
This is ironic. This is the best one community. My portfolio, and Monique picked the best name, Monique being our podcast manager. She and I have combined forces, got the Italian blood of Monique with the Polish stock picking and whatever else I bring. 15.85% in the green.
Yeah.
Big wins from RPM Global, so we know that's going to take over. So 52% positive. Westfarmers 35.
All of the value came from RPM.
My global healthcare ETF is the worst.
Yeah.
Who would have thought that the worst performer of the year is an ETF? That's good. I can't remember what I was going to say. 15.85%. I think
that's a great return.
It is, but that's exactly this number that the Rask Invest Jupiter portfolios returned
to 31 August.
Exactly the same number.
Yeah. With far less risk than you've taken.
I've got to be honest, this is just a joke money portfolio. This is equal weight, as you'll remember. GGAS up 10%. I think if Trumpy gets more Trumpy,
G-Gus will tank.
I think G-Gus could
Fly. All right.
Yeah. Because the Australian stock market has greatly outperformed the US market for the first time in a long time.
Yeah.
I don't know if that can continue. Okay, so we've got time for a couple of quick questions here on the end of the show. Didn't you have some questions for me?
I did have some, yes.
Let's do your questions, and then we'll just bank some community questions for next week, because we have got questions about ETFs and dollar cost averaging and debt recycling and so many other things. You give me some of your questions.
Here's one. 5 assets, we can call it 3 if we want to keep it short, that you would buy and hold for the next 30 years. 5's probably too many, unless you want to talk for 20 minutes.
3 assets.
3 assets that you have to buy and hold for the next 30 years.
I'd definitely buy Australian real estate.
Yep. Resi,
yeah, 100%. But it'd have to be high land to house ratio. So, so land to value ratio is a key metric for describing property performance. So,
yeah.
This is why apartments and that aren't as good investments, because a lot of the value from the land appreciating, not the building depreciating. So that's one thing that I'd buy is resi property in an investment grade suburb, and I would overextend myself. Why?
30-year duration.
Because it's 30-year duration and interest and the way debt works in this country with money supply and quantitative money and blah, 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 inflation. Pete always talks about this on our property podcast, is debt inflates itself away.
Yeah.
So debt, $2 million of debt today is not going to be worth nearly as much as $2 million of debt.
Because your debt doesn't increase like your
like the
value
value
of
of the assets do.
Yeah.
So it inflates away.
Which is what happened to the boomers.
Yeah, exactly. Yeah, they got a lot of debt and they benefited from that. We did a number yesterday, 1985, the average mortgage was it $37,000 or something?
Yeah.
Or something. It was like 2 times income. That would be the first one. Second one would be, I'd probably buy Soul Patts. If you're going to say Aussie company, Soul Patts.
Yeah.
Because why? It's anti-fragile.
Yeah.
As long as the family's in charge and people like Tom and
diversified.
and that, and they're involved, I'd happily buy that.
I'd throw Westfarmers in.
Westfarmers in there too.
Same thing.
And then the final one, I mean, this is I have this kind of like itch about ETFs that I wonder in 30 years if they'll be as popular as they are today.
Yeah.
And if they'll be as supported.
Well, they're saying there's more ETFs than there are stocks.
They probably would be. Well, there's 400 ETFs, over 400 ETFs.
And we're going to get to a point that you're going to have ETFs over stocks, like 3 times, if we don't already, 3-time leverage Tesla.
US, you can buy like inverse Tesla and leverage Teslas and stuff.
Yeah.
What would you buy? You got Westfarmers?
I had Westfarmers in there. I think infrastructure over 30 years.
Yeah.
Like you look and like electricity infrastructure, all those and you can probably start to put data centers into that infrastructure as well.
Mm-hmm.
And I mean, the last one, this is a question for you, not for me. I think you've got to be looking at private markets and sectors within private markets. And I think it comes to either a property or artificial intelligence play over that period of time.
Yeah, great. I agree with you. But I took just a question is like you kind of have to hold it. You can't really do anything
trade
to
it.
it. Yeah.
And it's a similar thing. It's a commercial property play as it is a residential property play.
If I was really shrewd, probably what I'd do is I'd go a pre-IPO and small cap Australian shares fund, but only if that fund committed to a hard close.
Yeah.
So you couldn't
don't keep taking money in.
It couldn't ever have more than $100 million. And it was a really good fund manager, a young fund manager, late 20s, bought into
staying there for 30 years.
Who's going to stay there for 30 years.
Yeah, that's the problem, isn't it? Because you can't get out if the PM leaves.
Maybe 2 PMs, an older one and a younger one, just to balance each other out. But then that way you could bank on them for a very long period of time.
Yeah.
That's it, Drew.
I had a buy, sell, hold for you as well.
Go for it.
Buy, sell, hold. I've got a few of them.
Mm-hmm.
The artificial intelligence spending and actually being executed within the next 5 years.
Buy.
You think it's going to happen?
Yeah, I think that if cloud computing is $1 trillion industry now, I think AI will be bigger.
All right, that's a good one. Oracle.
We'll hold because we will look at it over the next few weeks, but for now, hold. I think it's a great company.
Why?
Anyone that has a flavor saver like that and has continued it for 3 decades must be trusted.
And his son's so clean cut. It's like complete opposite.
Yeah.
WiseTech.
Buy.
Buy. Yeah. Hub 24.
I think it's going to be volatile, but I'd buy.
Shackets.
Sell.
Clearly. Westfarmers. I'd say on a 12 for Westfarmers, 12 months.
Oh, hold.
5 years.
Buy.
All right. And the last one, News Corp.
Sell. Even with the changeover.
Even with the deal.
Well, I don't know.
Lachlan's in charge.
I don't watch Succession, but if I did, maybe I have a better understanding of
this is a bit clearer.
Fiction.
Lachlan basically
But he used to run Channel 10 and everything like that. He
took a loan and sold money to give $2 billion to his siblings.
Which, yeah, I mean, it sounds like he's the one. He will always seem like the one that would do it.
Yeah.
I know. What would you do with that? You know more than me.
I kind of, not the Murdoch story, but that's obviously a bit of
But News Corp, it also owns REA Group and a bunch of other things.
Yeah, I mean, Dow Jones.
The
businesses it owned, it's actually been pretty flat. This is one of the stocks I'm thinking about looking at for my dabble back in stock picking. It's been quite flat, but the digital business, the media business is quite good. Depending on your political persuasion, you might consider the content, but I don't mind. I think it's a buy without doing too much research.
Okay, yeah. Bye for now.
At the moment.
Bye for now, which is what I will be saying to everyone. Bye for now. Bye for this weekend. We'll be back next week. We've got plenty more to come. I'll be sipping a mojito when you listen to this show next weekend because I'll be in Port Douglas. Shout out to anyone who's in Port Douglas. Come have a coffee. But Drew, you can find at waterpartners.com.au. He's also on YouTube. If you just Google Epic Retirement Mistakes, he'll come up as number one. But seriously, retirement advisor, waterpartners.com.au. You can find out more and subscribe to them on YouTube if you are listening or watching. We do have to get a dad joke from Drew. Drew did send me a meme the other day. It said that women are more attracted to men who say dad jokes. Which
you can't stitch me up like that.
I question the validity of that research, but maybe. Maybe. For Drew's sake, maybe. All right, mate. Lay it on me.
Oh, actually.
Oh, and send your questions in. And more stock suggestions because we've got heaps this week. We just didn't get a chance to get to them. We've got some great names. Lots of US and Aussie companies in there. We're going to do more this year.
I actually almost completely forgot this week. Why did the investor bring a ladder to the stock market?
To climb.
Because they heard the market was going up.
Well, it's on brand for us.
Yeah.
Yeah. I'd give you a 6 out of 10.
It was ChatGPT. I completely forgot I did a dad joke this week.
Well done. Well done to ChatGPT. Well done to Mr. Chad. If you want to leave us any heckling or comments, you can do that via the link in your podcast player on YouTube or via Spotify if you listen over there. We do prefer to have all the questions. We got a lot of stock suggestions, a lot of feedback for this week and companies we should look at. We may even be doing 3-way 2 cents coming up, so maybe it'll be 3 cents. But we've got a lot of feedback. The easiest way to cut through it all, though, guys, is to one of two things: is to go to the link in your podcast player or YouTube description. That's because we'll actually read everything that comes through there. It's the easiest way for us. Or secondly, to jump into the community, which is free, and you can just have a bit of banter. I'm in there every day. It's community.rask.com.au. It's free, so check it out. Drew, Water Partners, pleasure.
Good to see you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.